a proration, or it's just asking you how something might show on a closing disclosure. But this is also a really important concept to understand for in the real world with your seller, how much money they're able to walk away with when they sell their property, and for your buyer, how much money they need to bring to the closing table. So understanding this whole systems and credits and debits will really give you a deeper understanding of how really to come up with these preliminary numbers. Now, of course, you'll have the actual closing disclosures in the real world to go off as the final numbers, but a lot of times they want to know ahead of time an idea, a ballpark estimate of what they're getting themselves into, how much money the seller's going to walk away with. That's essential for negotiating a listing, is getting back to that bottom line. The commission all of a sudden is as big of a deal when you look at the bottom line of how much money they're able to walk away after this whole set of debits and credits apply. So that's what we're talking about today. Debits, credits, whether you're studying for your real estate exam or you just want a better understanding of debits and credits for the real world, this is the show for you. My name is John Christma. The show is brought to you by the Tampa School of Real Estate. You're watching Ask the Instructor.
You are watching Ask the Instructor. Absorb the knowledge. Become the expert.
And welcome back to this week's episode of Ask the Instructor. My name is John Christma. The show is brought to you by the Tampa School of Real Estate. We're here every single Wednesday, helping you understand the technical side of the real estate industry. And this is live, so if there's anything it is that you've got questions about that you're not sure of, drop that in the comments and we'll help you out. But let's get right down to today's topic for credits and debits. So credits and debits. First off, let's just come up with the definition of the credit versus the debit. So a debit is where you pay money, whereas a credit is where you receive money. So debit is pay, credit is to receive. And that is always true across the board anytime you're dealing with any credit or debit. Now, the more as you work with these, the more as you kind of see this, you'll start to just remember that a debit means you pay and a credit means you receive. But until you get to that point, you might want a little trick to help you remember that a debit means you're going to pay and a credit means you're going to receive. So think of if you go return something at a store, and for whatever reason they give you a store credit. That is money you're receiving. So think of that. Or if you have a credit card is where a company extends you a line of credit, where maybe American Express is extending you credit. You are receiving credit. You know, you do something great, you receive credit. So whenever you think of that word credit, most of the time it's related to that word receive, that you're receiving something. And especially when we're talking about the accounting system here that we're using on closing disclosures. And these are the same rules that apply for general accounting as well. Now for debit, this is where you're paying money. So with a debit, think of like a debit card. You have a debit card. If you pay for something with a credit card, you were given that money. You were given that line of credit. Whereas when you pay for it with a debit card, you're immediately paying that out of your bank balance. So that's really the whole idea of a debit and a credit. But now the next question is, where is something a debit and where is something a credit? What are the typical items in a closing disclosure that also might show up on your real estate exam, where it could ask you what is a debit and what is a credit? How does this work with prorations? We've got the answers to these, but first we're going to take a quick commercial break. Stick with us. I'm John Christma. You're watching Ask the Instructor.
The most powerful tool to study for your real estate exam is the Question Simulator from Tampa School of Real Estate. We've used our years of experience in preparing students for the Florida real estate exam to bring you the most powerful exam study tool available. In the question simulator, you'll be able to go directly to a particular unit so you can focus on the sections where you need the most practice. We have also included the percentages of each unit so you know which units are the most important for your real estate exam. Every question will immediately give you detailed feedback, which is almost always more important than the question or the answer themselves. After completing all the questions in a particular unit, you can go through question by question and review any that you've gotten wrong. You could also print out a report at the end of each quiz. The question simulator from Tampa School of Real Estate is 100% mobile compatible, so you can practice with test questions anywhere you have your phone with you. Enroll now at questionsimulator.com and get ready to pass your exam.
Hey, welcome back to this week's episode of Ask the Instructor. I'm John Christmas. The show is brought to you by the Tampa School of Real Estate. Today we're talking about debits and credits. Now, we just covered a debit means that you pay and a credit means that you receive, that you're receiving money. But now the question is, okay, well, what items are going to be debits and what items are going to be credits? So let's first start out with probably one of the most important numbers. One of the most important numbers. It's maybe arguable which one is the most important number, but this one's definitely top of the list, and that's the sale price. So let me ask you this. Is the sale price a debit or a credit? So sale price, is it a debit or a credit? Now, if you're ready to answer that question as either debit or credit, you're not thinking deep enough, because the sale price is going to be a debit and it's going to be a credit. It's really the bigger question is it a debit or credit for the seller, and is it a debit or credit for the buyer? Now, it's going to be one of each for each side. One for each side. So, if we think of, again, the debit, and again, what does debit mean? Debit means that you're paying. So, let me ask you this. Who is paying the sale price? Well, that's going to be the buyer. You usually don't have the seller buying their own property, so it's the buyer that's paying the sale price. But now this money that's being paid by the buyer, what happens to that money? Well, ultimately, it's going to be received. That sale price received, remember, credit means to receive, and that's going to be received by the seller. So the sale price is both a debit and a credit. It really is more so about who is it a debit to and who is it a credit to. It's a debit to the buyer because the buyer pays the sale price. It's a credit to the seller because the seller receives the sale price. So let's go through another example here. That's the sale price. That's definitely an important one to remember. Let's talk about new mortgages. So what is a new mortgage? Is that a debit or is that a credit? And we'll say this is a new mortgage from a lender. So a new mortgage from a lender, and we'll talk about why I had to add that little disclaimer of that it's from a lender as opposed to maybe from somewhere else that would change this a little bit. So if it's a new mortgage from a lender, what's going on here? So when a new mortgage is taken out, a buyer's taking out the mortgage to purchase the property. Why are they getting the mortgage? So they could get money to purchase the property. So the buyer is going to be credited the amount of the mortgage. Now you might wonder, okay, well, who is debited? On your closing disclosure, nobody. Nobody gets a debit for this when it's from the mortgage lender because it's really the lender. They're the one paying this money to the buyer. And remember, we're just thinking about what's happening at closing here, not what's going to happen over the long run, because ultimately this money is going to get paid back to the lender. But at the time of closing, the buyer receives this mortgage loan from the mortgage lender. Now, let's change this a little bit. Let's say instead of a lender giving the mortgage, let's say It's the seller. Basically a seller financing type of idea with the vendor's lien and purchase money mortgage. Maybe you remember all those little details of that there. So if the seller now is the one loaning the money to the buyer, now we do have somebody that was on the closing statement. Remember, the lender, they're not one of these two parties. They're not the buyer or the seller, so they don't get a debit for the lender. There'll be a credit to the buyer, but no debit to the lender when it's a lender making the mortgage. Because again, the lender isn't one of the two main parties on the closing statement. But the seller is. And that's where we would have a debit appear from the seller, because the seller's being debited this money and now the buyer is receiving this money. So the seller would be debited this and the buyer would be credited it. And what this is ultimately going to mean here, we probably got enough room to put this down here. So let's talk about the seller side of the closing disclosure. And on the seller side, we're going to have our price being the credit. That, okay, we've agreed upon a $250,000 price. So $250,000 price, but now let's say the seller is the one that's loaning the money to the buyer. Now, the price, this is going to be a credit to the seller. And then over here on the buyer side, this same price is going to be a debit to the buyer. So we've got minus $250,000. You see how that's working out right there? This buyer is paying $250,000 and the seller's receiving that $250,000. Now let's say the seller is the one financing this. If the seller is the one financing this for our, we'll just call it loan for short here, our purchase money mortgage offered by the seller, for let's say it's a $200,000 loan. So now the seller is debited that $200,000 and the buyer is receiving or credited that $200,000. Now you might already kind of see what's going on here. If we put what's in blue here for our net amounts, and let's assume there's no other closing costs. In the real world, we've got a whole long list of all these debits and credits that are all somewhat canceling each other out. So the seller received a purchase price of $250,000, but they loaned $200,000 to the buyer to be collected as payments for whatever term it is they've agreed to. So what this means is the seller is only going to walk away with how much? Well, if they took in $250 but they paid out $200, this would be the net to the seller, this $50,000. Whereas on the buyer side of things, so we've got the seller, we figured out, okay, the seller's walking away with $50,000, and of course, again, there's a lot more items we would end up having to debit and credit that would break down to the actual net amount in the real world. But again, let's just assume these are the only two things. On the buyer side, they paid $250,000, but they received a $200,000 loan, so they still have $50,000 of cash needed to close. In order to buy this property, yes, they've got $200,000 accounted for through this purchase money mortgage they just got from the seller, but they still need $50,000 to come up with that balance there. And this is really what you're doing with the systems of credits and debits, where you're figuring out, okay, is this something where somebody's paying something or somebody's receiving something, and you come up with this great big long list and you balance it all out, and what you're left over with for the seller is how much they're able to walk away with, and for the buyer, how much cash they need to close. Now again, this is very simplified here. We're only dealing with two items, and in the real world there's many more than this, but you could probably start to see where this is going to be useful in your real world as well, not just for exam purposes of understanding debits and credits, but in the real world as well. This net amount, that's what the seller is going to be most concerned with. Yeah, they might make a big deal about whatever commission rate it is that you're charging, but it's ultimately because they care about the bottom line. This is our bottom line for the seller. And the better we could get at estimating this up front and delivering this information that this is how much they're going to be able to walk away with, the more understanding they're going to be of the whole process, what we're contributing to it, and so on and so forth. Now, on the buyer side, this is also helpful. So we could easily tell them, hey, look, it doesn't cost you anything to use our services. The seller's going to pay our commission for us. But you're still going to need money to close on it. And it's not just the down payment. Here we're only looking basically at the down payment, but there's going to be a lot of other factors that play in to what the amount is going to be for the cash needed to close. And this really is what makes the affordability real. Now, in the real world, you typically have lenders and title companies maybe helping you a little bit more through this process here. Really, in the real world, whenever you're trying to come up with these calculations, you shouldn't just be doing these on your own because you're not the one closing the transactions. A lot of title companies have great calculator tools that you could use, that you plug in some of these numbers here, you plug in the different items, and it'll automatically balance this all out for you, and it gives you a lot better estimate. But you still need to understand the basics of how this all plays out and why they're only walking away with $50,000. Now, in this case here, if the seller were making a $200,000 loan, it should hopefully seem obvious to that seller why they're only walking away with $50,000, because that remaining $200,000, they're going to get as monthly payments plus interest for however long. But it's usually not quite that easy. Now, we got one other thing we need to talk about with the mortgage, as well as some other closing costs and the prorations, and again, working through this whole thing of how this all balances out. But first, we're going to take a quick commercial break. Stick with us. I'm John Christmer. You're watching Ask the Instructor. Have you completed your post-licensing education yet? Look, I know you're probably thinking, hey, it's not my renewal deadline. I don't need to do post-licensing yet. But look, here's why you want to do post-licensing as soon as you've got your real estate license, as soon as you're able to take post-licensing. It's not just another course about arbitrary laws that you're never going to use again. It's about real-world, usable topics that'll help you grow your real estate business, to help you take it to the next level. Look, let me ask you this one question. If this course helps you close just one deal, if you get one extra deal from post-licensing, is it worth the investment? I'd say it is. We get paid pretty well, so one deal means a lot of money. Check out postflorida.com. That's postflorida.com for the full details about post-licensing. Hey, welcome back to this week's episode of Ask the Instructor. My name is John Christman. This show is brought to you by the Tampa School of Real Estate. We're here every Wednesday, 12 noon Eastern Time. If you haven't subscribed yet, hit that subscribe button. Make sure you hit the little bell icon so you get notifications whenever we go live and you don't miss out on any of this information we're delivering every single week, basically every single day. Now, we've talked about two mortgages that might appear on closing statements. We talked about first the mortgage from a lender, which would only show up on the buyer side. And let's actually go back to that before we talk about this third type of mortgage. So when it was from the seller, that's where the seller would be debited this. But let's say that this is a mortgage from a lender who's not a seller. So now all of a sudden, the seller isn't the one paying that loan. So the loan is over here on the buyer side, that the buyer's receiving this, but they're receiving this money from the mortgage company. They're not receiving this money from the seller. So now the seller would be back to getting, assuming there's nothing else going on here, which wouldn't be the case in the real world, they're getting that full purchase price now, that would be their net. That's how much they're walking away with because they don't have any debits here eating away at that. But let's say the buyer still has this $200,000 loan that they're taking out. But let's say over here with the seller has a loan that they're paying off. So let's go ahead and go down the list here and just run out a bunch of different things for what you'll typically see in a normal closing disclosure. So again, we've got our two columns here. The seller and the buyer. And in the real world, they usually do these as 4 columns, 2 columns for each side with debits, credits, that type of thing. But we're just going to do this a little bit easier and just do that whole green and red like we've been doing. So, a little bit closer so you guys can see this good. We're going to start off with our price. which, again, the seller's receiving. And we'll say this is $250,000. And that same price is what the buyer is paying, at $250,000. So there's our price. Now, how is the buyer paying for this? Well, they're taking out a new mortgage from a lender, so that's not affecting the seller side at all, but that is now crediting the buyer. Let's say it's a $200,000 mortgage. So buyer took out a $200,000 mortgage. You can see what we're at right here, that the seller is right at this point, they're getting $250,000. They don't have anything eating away with this. And the buyer is paying $250,000. They've got a $200,000 new mortgage. So at this point, they need $50,000 to be able to close on this property. But we're not done yet. So let's say that the seller has a mortgage to pay off. That the seller doesn't own this property free and clear, that they got a mortgage that they're paying off. So let's say it's, I don't know, $150,000 that they owe. So that's going to show up as a debit to the seller. We've got the price paid by, that received by the seller, $250,000, but now they've got $150,000 goes to paying off their old mortgage. So that way they could walk away without still having to make payments on that mortgage. They're paying off their mortgage. So that's going to eat away. That's going to debit away $150,000. So now you can see we're left with $100,000. So the seller's walking away with $100,000. The buyer needs $50,000 in cash to close. Now another big expense, and we won't do the full calculation for this. We'll just, make a nice easy round number to calculate with here, would be the commission. So how much commission is having to be paid here? And let's just say it's $15,000. And we'll say that's for both sides of this sale. That's also going to be a debit. So now we went from the seller receiving $250,000, but they've got to pay off their mortgage, $150,000. They're paying the commission for the transaction. Typically, it's the seller that pays the commission. So there's $15,000 gone. We did have $100,000 we're walking away with here, but now subtract another $15,000, and we're down to like $85,000 the seller's able to walk away with, which still sounds like a pretty good amount. Now, we're not done yet. So let's say that there's some closing cost. And again, we'll just use nice, easy round numbers here. Let's say that we've got $5,000 in closing cost for the seller, and we'll just say we got another $5,000 over here on the buyer side. So this basically going to the title company. So now we've got debit and another debit. And this depends on what you negotiate in your transaction. Maybe you negotiate that the seller pays all the closing costs or that the buyer pays all the closing costs. But this is, so the thing is, not everything is always going to be equal across both of these sides here. The purchase price, this is where it's going to be equal, because if the buyer pays $250,000, the seller should be receiving $250,000 for that price. There shouldn't be any money going missing or extra money being added to that price there, because that's all that the buyer's paying. But again, for that new mortgage, when it's coming from a lender, the seller isn't affected by that. The mortgage payoff of the seller's existing mortgage, the buyer isn't affected by that. The commission amount, typically the commission is paid entirely by the seller. So the buyer isn't affected by what commission has to be paid. But then we have our closing costs, all kinds of little fees and title insurances and things like that add up. And again, this is why you want to use a title company in the real world to come up with these preliminary estimates, so you don't just have to ballpark it like I'm doing here and saying, oh, well, $5,000 maybe. Maybe it's less, maybe it's more, I don't know. What's the point of doing this estimation if it's not at least somewhat accurate? So that's why, again, team up with some sort of title company so that way you could drill down a more realistic estimate rather than just pulling some number out of your head like we did here for $5,000. But yeah, so closing costs. Both of these are debits. These are separate amounts that the buyer's paying. And let's just make it where they're a little bit different here so it does show that they're separate. Let's say the buyer only has $4,000 in closing cost, because these again are not meant to be equal. These are separate amounts for separate charges. $5,000 paid by the seller, $4,000 paid by the buyer. So now what did this just do? What did this just do to the buyer side? We know that we're getting smaller and smaller and smaller with what the seller is able to walk away with, but what is this doing to the buyer side of the transaction here? How is this affecting the buyer? Well, we started off with the buyer having to pay $250,000. The buyer was having to pay $250,000, but they got a $200,000 mortgage. They got a $200,000 mortgage, so now they only have to pay $50,000. But now they also have $4,000 in closing costs. So it's no longer just that $50,000 down payment, it's now $54,000 to encompass these closing costs. But we still have some prorations. So let's say for our property tax proration. Now, the property tax proration is almost always a debit to the seller and a credit to the buyer. And that's if taxes haven't been paid. It's always a debit to the seller and credit to the buyer. This is another one where they will be equal because we're talking about the same dollar amount here. So what we're going to see with prorations, and this is pretty much the case for all the prorations, especially ones you're going to see on your exam. In the real world, this isn't always the case, but most of the time, it's going to be a debit to the seller and a credit to the buyer. So for the property tax prorations, we take what the annual property taxes are and we split it up, and the seller's fair share of property taxes, let's say, are $3,000. So there's another $3,000 that the seller is not going to receive when they walk away selling this property. But now, what does that $3,000 do? Well, that's actually going to be received by the buyer. Now, why is the buyer receiving this money? Why is this not going to the taxing authority? Because the taxes aren't payable yet. That's why we do a proration for property taxes, because the taxes aren't payable yet. Because otherwise it'd be a lot easier just, okay, let's just pay it all in advance, or let's just pay it all after. But we usually don't have that option because the taxes in Florida don't become payable until November 1st. So what the idea is here, that let's say the entire tax bill for the year was like $4,000. It was $4,000 for the year, and based on the date we're closing, that ends up being $3,000 that the seller is responsible for. Now, we don't care about what the buyer's responsible for, because in the end, the buyer's going to have to pay for that entire property tax bill. But at closing, we're receiving a credit from the seller. We're receiving this $3,000 the seller paid, so in theory, we set that money aside, so when the taxes do become payable, we've got that $3,000 already set aside there. So again, you can see that for the seller, most of the things for the seller are going to be debits. Really, the only other thing you'd have that is going to be a credit is if they're prepaid for something. If they prepaid for maybe HOA dues, or there could be some prorations maybe that do give the seller a credit. But usually the only credit the seller's getting is the price, for the most part. That's the biggest one, at least. And then everything else is debits, eating away about of that $250,000 for what they're going to be able to walk away with. And then over here on the buyer side, we've got the $250,000 that the buyer paid, but they got a $200,000 mortgage. So now they're only on the hook to pay $50,000 at closing. But then they have $4,000 in closing costs, so now they're up to $54,000. But then they also have a $3,000 credit for the property tax proration. So now they're at $51,000. So you can see again how this all balances itself out to figure out this whole system of credits and debits. Now, we do have one other thing we need to talk about, and that's the earnest money deposit. Where does the earnest money deposit show on here? We're going to cover that, but first a quick commercial break. Are you studying for your Florida real estate exam? If you are, you need to check out our Pass First Try strategy. You're going to love this. It's 4 steps that we break down the process to study for your Florida real estate exam. So you're set up to pass your Florida real estate exam, because that's what you're studying for, right? To pass your exam. It's 4 steps. Number 1, you learn the information. You've got to learn this to be able to pass the exam, but it doesn't stop at learning. Step 2, you've got to reinforce the basic, simple, key concepts. As you learn this information, keep reviewing the simple things. You don't need to know everything, but you got to review these basic key concepts. Step 3, you've got to test your knowledge. The exam's going to test your knowledge, so if you don't test your knowledge in advance, you won't find out if you know what you think you know until you take the exam. And then step 4 is be confident and prepared, because even if you know this material, you need to be confident that you know the material. Check out the full strategy at passfirsttry.com. That's passfirsttry.com. Hey, welcome back to this week's episode of Ask the Instructor, where today we're talking about credits and debits, understanding first and foremost what a debit is and what a credit is. If you missed that, you can rewind back to the beginning of the show after this is over. We've got all of our episodes of Ask the Instructor in State of Real Estate at tampaschool.com/success. So you can rewatch this one as many times as you need to, and we've got tons of videos, hundreds of videos. I think we're over 1,000 videos that we have now. And if you're not subscribed to us, hit the subscribe button. We'd really appreciate it, and I know you're going to appreciate all the information we deliver every single day. Now, we've gone through basically all of these main things that you're typically seeing on an average closing disclosure, but there's one thing that you typically will have, almost always will have, but we haven't talked about it yet, and that's the deposit, the earnest money deposit. So the earnest money deposit is what the buyer puts up in advance. So let's say the buyer in advance made a $10,000 deposit. So at the time of contract, when the buyer and seller agreed to this price and they agreed to the terms of the contract, the buyer said that they would give a $10,000 deposit, so they've agreed, and the buyer paid that $10,000 deposit. They wrote a check for $10,000 that went to the title company or to the broker escrow account or to an attorney escrow account, and it's been sitting there in escrow, in this trust account, until the day of closing comes. Now, the day of closing is here. What's going to happen with that $10,000 the buyer already paid? Well, the buyer is going to get this money back in the form of a credit. So the earnest money deposit is going to be a credit to the buyer, but now how does that show up to the seller? It doesn't. The seller doesn't have anything to do with the earnest money deposit. Unless the contract gets breached and the seller's entitled to get that, to collect that earnest money deposit, and we've got the result of the resolving of the conflicting demands. Other than that, the seller doesn't get this money. On the closing, this earnest money deposit just goes back to the buyer. And let's say there was no cash needed to close, they would get a check back for what that earnest money deposit is. So when the buyer closes on the property, they're not losing that earnest money deposit, they're getting that money back. So that's the goal. They put up that earnest money deposit to show that they will act on good faith, that they're going to do what they said they're going to do. And now here they are doing what they said they're going to do, so they get that money back. But that doesn't affect the seller's numbers at all, because this is ultimately what factors into that total purchase price. All of this over here, plus our cash needed to close, is going to add up to cover this purchase price, as well as all of our other expenses like the closing cost and things like that. And then we eat away at everything that the seller's getting, to what we're left with is how much the seller's actually walking away with. So really this whole process almost would look like this in a certain sense. That we're taking that cash that's needed to close from the buyer, whatever the result is here. We needed $51,000 here. Now we only need $41,000 because we already did $10,000 in advance. So the buyer pays that $41,000. That makes all this work to where the seller could receive the $250,000, and then all these other charges can go through to when the seller is left with what their net is, or how much it is they're going to walk away with. And that's what we use credits and debits for. It's really just words for plus and minus. That's all it is. It's just accounting words for plus and minus. It means the exact same thing. A credit is a plus, a debit is a minus. And that's all we were just going through here. And you can see all these ones in red with the minuses, those are debits. Everything in green with the pluses, those are credits. That's all this is with credits and debits. So this might seem a little intimidating at first, but once you start to go through this and you're really understanding and you're asking that question, okay, with a new mortgage, what is that doing? Just like when we started off with the purchase price and I said, hey, is the purchase price, is it a credit or is it a debit? And really the correct answer would be it's both. It's a credit for the seller and it's a debit for the buyer. Because what we're doing here is we're figuring out, what does the price mean to the seller? What does the price mean to the buyer? What does the new mortgage mean to the buyer? What does the mortgage payoff mean to the seller? That's all we're doing here. That's all it is with debits and credits. Your credits are your pluses, your debits or your minuses. So look, that's about all the time we've got for today. If you've enjoyed today's video, we'd really appreciate it if you give us a thumbs up, share it with your friends who are studying for the exam. We've got a ton of great free videos out there for you studying for your real estate exam. But if you want something a little bit more tailored specifically to helping you pass your exam, we've actually developed something we call the Pass First Try strategy, which is our recommended strategy to help you pass your class and state exams on the first try. That's the goal, right? Get this all done, knocked out, so you can go out there and make your millions in real estate. So this Pass First Try strategy, we've got it broken down at passfirsttry.com. We've got a lot of great study tools that are built to meet each one of these different steps. We didn't build study tools and then make a process to fit those study tools. We made this process and we build all of our study tools out to accommodate this process, to walk you through this process of first learning the information, then reviewing the key points that you need to memorize, to being able to apply those key points in practice questions, to being ready and confident for your exam. So if you want to find out more about that, check out passfirsttry.com, or better yet, give us a call. We've got advisors standing by. If you've already taken your exam and you're having trouble passing your exam, give us a call. We'll help you out. It doesn't matter if you went to a different school, if you took your course online, whatever the case may be, we could help you. Even if you haven't taken your course yet, we're approved by the Florida Real Estate Commission to offer those courses both in classroom and online, and we have a great online course as well. So give us a call, 813-333-2676. We want to help you achieve your dream real estate career, whether you've already got a real estate license and you want to take it to the next level, or you're just getting started. 813-333-2676. That's about all the time we've got for today. Thank you guys for tuning in, and I'll see you on Friday for State of Real Estate. Hey, so if you're thinking about starting a real estate career, it could feel a little overwhelming sometimes. Look, that's completely understandable. That's why we're here to help. If you haven't already, check out our Success Center, tampaschool.com/success, or if you don't even know where to begin, give us a call. We'd love to help you out. We've got advisors standing by to answer any questions you have and assist you in any way it is that we can. Our phone number is 813-928-0106. Again, that's 813-928-0106. Give us a call. We're the Tampa School of Real Estate.
Do you want a career that allows you to be in control? With a career in real estate, you'll get to call the shots. Whether you're looking at starting part-time or want to become the next top agent, a career in real estate makes it possible. Find out what it takes at tampaschool.com. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com.
Are you thinking about a career in real estate? Hey, I'm John Chrisma with the Tampa School of Real Estate, and we've helped thousands of people just like you obtain their real estate license. If you're thinking about a career in real estate, give us a call. The phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way they can. Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.